if you're trying to hedge LIBOR today at 3.5, and the Fed is signaling that they might raise rates again, you might end up paying $500,000 or $1 million for a hedge like that. If it's threatening to be in the money right away, then you're going to pay more.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Eddie Ring founded New Standard Equities in 2010 and serves as its chief executive officer. NSE is a leading vertically integrated real estate investment and asset management firm on the West Coast. Eddie, welcome to the show.
Yeah, thanks a lot, Sam. I appreciate you having me on.
The pleasure is absolutely mine. Eddie, there are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Oh, yeah, sure. Well, actually, I started off my adult life as a sitcom writer in Hollywood, of all things, if you can imagine that. It was a lot of fun. It was really super interesting and obviously a barrel of laughs. But being unemployed 60% of the year was really not a barrel of laughs. And I decided with 2 little kids that daddy couldn't be this unemployed. So I actually went back to UCLA, got my MBA, and jumped into the real estate space. I started off at a pretty large company based in Beverly Hills and sort of learned the ropes and learned the multifamily industry. And that was back in 2002. And in 2010, I started my own firm. And here we are today. I've got about 2,000 units under ownership and management, and it's all exclusively on the West Coast. And we do value add apartments. Do the same thing every single day. I wake up, I'm like a fisherman. I go out, catch some fish, I come back the next day, do the same thing. So it's been terrific, and I'm happy to share my experiences with you and your listeners.
That's fantastic. Yeah, it's not every day that we get sitcom writer turned multifamily value add apartment investor. I know you said that you guys, focus exclusively on the West Coast. The West Coast gets a bad rap, I think, industry-wide from the people that don't invest in the West Coast, which is, maybe good for you, maybe bad for you. But tell me, why do you guys see opportunity where you are right now?
Yeah, well, first and foremost, I think that the true guiding principle for myself is what I know. And I kind of alluded to that a little bit. But I was born and raised here on the West Coast, and I understand it. I understand the market. And when I first started going off on my own, I literally told investors, look, I'm not going to put your money at risk for my ignorance. And, you're not paying me for that. Instead, I know the West Coast. I know Seattle, Greater Seattle, Portland, San Francisco Bay Area, all parts in between, and Los Angeles and Southern California, San Diego, Orange County, et cetera. And I know all of the little submarkets to invest in and what to avoid. And with that knowledge, I feel like I can overcome some of the things that most investors are worried about, which is the political risks and the odd temperature out here, especially in the last couple of years, seeing a lot of issues. But at the end of the day, the reason that I am still a fan, other than the fact that, I know the market, the cold, is that on the West Coast, we have super high paying jobs, and it's where the innovation is, where the knowledge economy sort of begins and ends. And we really think that, especially in our space, in the value add multifamily space, we're able to cater to that resident and cater to the demographic that is up and coming, is their incomes are high and growing, and there's really no substitute. We're pretty big in Greater Silicon Valley, so not quite the valley itself, but all of the sort of 2 or 3 rings out, if you think of it as like a set of concentric circles. And that dynamic, rising wages for the most part, last couple of months, maybe an anomaly, but we're very used to it. And, I'm going to stick to that, and the politics are the politics. And, I think that there's a way around all of that. At the end of the day, politics are a funny animal, because the same pressures that are preventing large scale development and things that would actually fix supply end of the equation are just not there politically. There's no political will to allow development. So when you have no development, you can whine all you want about rent control, et cetera. But the reality is you're going to need more housing. And if you don't build it, then the prices of that housing are going to go up. I'm charging now about $3,100 for a B-class property in San Jose, California, one of the higher rent areas in the entire country. But that's what the incomes in that region are dictating. So naturally, then the cap rates are going to be lower there than in other areas.
Right. No, I think that's absolutely an interesting perspective because, yeah, you can fuss all you want about, like you said, about the political risk, but at the same time, that it kind of cuts both ways. Where
Right.
it's for somebody like yourself, you understand the market, you understand the dynamics, you understand the political risks, and yet it kind of builds its own moat. Maybe not necessarily best for the end user, but builds a moat around your
Right.
business in its own right, where it's like, hey, this just prevents other competition from coming in, which
Exactly.
we won't get into the politics of it, but it just is what it is. I mean, there's no way around that. Can you break that down? One of the things that I don't have a firm understanding on, because again, we don't get to talk to a lot of multifamily investors on the West Coast here on this show. Can you break down rent control? Does that affect you guys? Is it just kind of a non-issue because of the size and the quality of assets you guys own? Or talk to me about that a little bit if you can.
Yeah, it's a fascinating topic, and it's the way I explain it to folks is that look, the reality is there's a social reality, and that is rent is really high here, and for working class people, it's very, very challenging to actually pay half your income in rent every month. So the industry understands that, and largely, in me and my peers are all like saying, yeah, we get it, but there's only one way out: it's new development, and any kind of rent control is going to make matters worse. So in the most in the most strict rent control markets in all of California would be San Francisco, and I'd say Santa Monica would be the sort of most restrictive. And there you have, when things hit the market on the sale side, you have things going for $750,000, $800,000 a unit, because they're so rare to actually have a building in that market. And of course, when you're paying that, then when a unit becomes available, that rent is through the roof. Now you have one guy paying double the rent, and the other, effectively subsidizing the rest of that community. And it's terrible, because that's the same people in the rent controlled units, or in, I'd say, the legacy unit. They're not necessarily the ones that need the housing. They're the ones that happen to have the rent controlled unit at the time. And so there's no like means testing or anything like that, which would make a lot of sense. But of course that's too difficult. It's a lot easier for the politicians to just wave their wand and say, no, we're going to cap your rent, or we're going to restrict what you can do on a go forward basis. And so in the last couple of years, there was something that the multifamily industry in the West Coast actually supported, because they felt that, left alone, the politicians would come on, but they came up with the idea of having rent caps. And so everybody said, well, how about we do 8%? This is at the statewide level in California. So I think we started off at like 8% plus CPI, and the state came back and we settled in on 5% maximum increases every year plus CPI. Well, CPI is typically 1 or 2%. So the industry, we could live with 7% increases every year. That's pretty good. And that's not going to really affect us that much. And of course, now with inflation and the CPI went through the roof, I think we're at a 10, 11% or 10% or something like that. Max for a 30-day notice, but nevertheless, about 10% a year, which it's a non-issue in terms of rent control and how it affects our models. And unfortunately, that program hasn't done anything to actually solve the problem. So there is no new development happening to speak of. It's very difficult to find land, and it's very costly. So ultimately, what ends up happening is a few people are able to move into nice new buildings, and everybody else has to live in stuff that's kind of quasi rent controlled, but the broad brush idea of CPI plus 5%, which really doesn't affect us all that much.
Got it. That's really interesting. Do you see any opportunity? And I know you said it's very challenging to get any new development through, and that's the one thing that would probably solve the issue, which is probably why it's never going to get through. But I mean, is there anybody out there forging into the new development space in a meaningful manner?
You see cranes all the time. You see folks, building out in Hollywood and building in parts of the San Fernando Valley. And you definitely see new development, but it gets absorbed so quickly that there's just no way that the units, to really affect price, they need to be sitting there vacant, and landlords need to be offering 2 months concessions or so. That, then you've really kind of hit the right point in the market with regard to demand. But we don't see that here on the West Coast. We see the cranes go up, the building doors open, and basically it's like a vacuum where people just get sucked right into the units, and you're leased up in 4 or 5 months for a 200 unit building, and we kind of march along to the next deal. So for a developer, if you could find the land here and get it entitled and have it blessed by the powers that be in the county and the city that you're in, then it's a almost guaranteed home run. Now, I'm going to tell you something that'll shock some of your listeners, on the East Coast, but new construction is $650, $700 a unit. So you're talking about, building out brand new for $650,000 or $700,000 per unit, which is, it's a function of the cost of the land. It's a function of construction there and insurance, et cetera. So there are a lot of charges and hidden costs that make development very, very difficult. And so even with rents at, $4 or $5 a foot, which, by the way, is what leads me back to Class B value add multifamily. If I'm only competing against Class C stuff or the Class A stuff, then I feel pretty good about being able to slice and dice the Class B market and, find those residents who truly want something a little bit better than the rest, but they don't necessarily want to spend all that money for Class A living.
That's a very different market dynamic that you have there on the new build side. I talked to a lot of developers and investors in the Texas markets, and a lot of people have gone to development because their value add Class B, B minus stuff is costing more than what it costs them to actually just build a new facility. And so it's kind of the other way around. It sounds like for you guys, where you can still acquire a Class B asset for less than what it would cost to build new.
Yep. Yeah, absolutely. We bought a property last year in the Fremont, which is, it's in the Bay Area, East Bay. It's laden with tech workers. It's former home to Tesla, I guess, before Elon moved, but there's still a Tesla plant there. It's across the bay from Facebook headquarters. And there's just thousands and thousands of tech jobs. And we bought this thing at $365,000 a unit, $380 a unit, something like that. And it was about a 3.5 cap, maybe a little bit higher. And I had investors asking the question. I privately syndicated that one. And I had investors asking me the question, especially folks that weren't familiar with pricing. They said, well, why should we buy something in Fremont that's $375 or $380 a door, something like that, when I can buy in Tampa at, $120 a door or whatever? And the dynamic that I explained was exactly what I just mentioned in terms of new construction. Whereas, I picked I named Tampa. I've never been there, but nevertheless, in Tampa, I don't think rents are, $3,500 for a 2-bedroom apartment, and I don't think that, single family homes next door to the project are going for $1,500 a foot. So you're talking about a pricing dynamic that's just entirely different on the West Coast, and especially in Silicon Valley type markets where you have, people work, programmers working at Google that are making $300,000 and they're still living in our apartment, Class B apartment. So it's just a weird, different dynamic, but one that if you put it in the right perspective, it makes eminent sense.
Right. No, that's absolutely true. Yeah, I think there's somebody else I was speaking to today, and I think they called it pocket economies, where it's like there's these little areas that once you know about them, once you know what the market dynamics are, or even on a block by block basis, such as what you're mentioning, about the tech jobs across the street from the asset you're buying, it's like, wait, this is a little pocket economy that on a large scale, maybe, people just couldn't understand from a macro perspective.
Right.
So I think that's really, really interesting. Tell me about this. Talk to me about the financing on your guys' properties. How are you guys taking deals down? What are you seeing capitals chasing? What are you guys seeing your investor sentiments are? Things like that.
Yeah. So, my typical deal, last couple of months things are a little bit different, or a lot different, but typically we would use floating rate debt. We would use agencies, Freddie and Fannie, and we would buy properties that are, because they require such a heavy lift that, generally speaking, we put as much debt as the agencies will allow us, or if we have to use a debt fund or something like that, we go to where is, what's most prudent. But because we're adding value, we can use a lot of leverage on the front end. We use floating rate debt, even when interest rates are so low, because we want to be able to buy, renovate, operate, and sell when the market dictates, not when our debt matures, or not when, not driven by debt costs. We want to really focus our business plan on adding value to the asset and raising rent according to market demand. And usually that's worked out pretty well for us. If you put a fixed rate loan on something, you got a huge prepayment penalty. And, I've been in deals in the past where the lender makes more money than the equity because of the prepayment penalties of the yield maintenance that you have to pay to get out of the loan. So nevertheless, by and large, we use floating rate debt, and we are seeing today that floating rate product is largely gone from the debt funds, at least in the short run here. Freddie and Fannie have come back to the market a little bit. They're a little bit tepid, but the lower leverage, okay, you can get something in the sort of 55 to 60% range today, LTV, and you kind of sort of have to raise a little bit more equity maybe than you would have, or put a little bit more in to make the deal work. But I'd rather have something that pencils for the lender and pencils for everyone than stretch that calculus too far. I've seen groups that just get way out in front of their skis using some of the floating rate stuff. And right now their portfolios are a bit of I wouldn't say they're necessarily in trouble per se, but they're definitely losing a lot of sleep at night.
That was going to be one of my questions, was when you guys use floating rate debt, how do you cap your exposure on that?
Yeah. So we have rate caps on everything. We buy a year or 2 years of a cap at the front end when we close the deal. So we know where our rate can rise to. And, frankly, right now we're still producing cash flow of most of our assets, but we've cut our dividends a little bit to be prudent, and we're building up a cash reserve to pay debt service in case rates keep going up. But for the most part, we've capped our exposure with interest rate caps that you buy at the front end of the deal.
That's absolutely awesome. I love that. And one of the things that, this is my ignorance speaking here, so maybe you can clarify for our listeners a lot better than I can. But what I've heard kind of in the industry chatter is that the policies, those rate caps that people bought, and let's say they paid $70,000 for them, they're now retrading at like $700,000. So 10 times what they paid for those rate caps. Can you break that comment down a little bit? Because I don't even know how to say that in a clarified manner so that people can understand it.
Yeah. So what's gone on in the rate cap world is it's like everything else, Wall Street. Everybody's just betting on what's going to happen in the future. And everybody's crystal ball is somewhat more accurate than the next guy's, I guess. But the reality is, if you're trying to hedge your bet on interest rates at say LIBOR of 3.5 or 4.5 or whatever, then the market comes back with pricing for that particular interest rate. So if you're trying to hedge it at 1% LIBOR, well, you're going to, you probably can't even get that today, but let's say it's a LIBOR of 2. The market thinks that LIBOR is heading to 5. Well, you're going to pay a lot of money for that LIBOR 2 cap, that hedge. If you're trying to hedge LIBOR at 7 and the market thinks LIBOR is going to stick around 4, then that 7 LIBOR hedge is going to be super cheap.
Right.
So you'll be able to pick up a quote unquote hedge. It won't do much good in the real world because you hedged it at a rate that's like, 1981, level or beyond that. But if you're trying to hedge LIBOR today at 3.5 and the Fed is signaling that they might raise rates again, you might end up paying $500,000 or $1 million for a hedge like that. If it's threatening to be in the money right away,
Right.
then you're going to pay more.
Right. I got it. Okay. That's absolutely interesting. Eddie, thank you for taking the time to come on the show today and tell us why you see value and opportunity there on the West Coast, how you guys are taking deals down, and just your general approach to the market. And I've just certainly enjoyed it. Thanks for breaking down some of these more nuanced topics, such as rate caps. I certainly appreciate that. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
I would say go to our website, newstandardequities.com. You can click right on the Contact Us tab. There's a little pull-down menu. You can go right to register as an investor or just info at, and I think that's how you get hold of me. You can also click on the investor login. I think there's a link right embedded in that for new investors if anybody would like to take a look at some of our projects.
Awesome. Thank you for your time today. I certainly appreciate it.
All righty, Sam. Take care. Take care. Take care.